What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the bond market. So there was a lot of interesting data points coming in, which suggesting TLT, which is the bond market ETF, 20 plus year treasuries, has seen significant amount of inflows in 2023. In fact, so much so that this is the third largest ETF with inflows in the billions of dollars this year, despite the fact that it's down over 40% year to date and it continues to sell off. Bond investors continue to believe. So that's what we're going to talk about in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below if you're interested in joining. We do have a 16% annual discount that's available till the end of this month, and you get access to all the buy and sell alerts, options alerts, trade ideas, members only private videos, trading you charts, a lot of other analysis and research, including our stock reports, is included as well. So link's going to be down below for another 13-14 days. You can get access for the annual 16% discount. So this right here was the report. Despite the big losses, investors flocked to long-term bond ETFs. So iShares 20 plus year TLT is down nearly 15% this year, and it's down over 40% from all-time highs. And despite the poor performance, that has not deterred investors, with investors have pouring in $17.2 billion into the $40 billion fund this year, making it the third most popular ETF in terms of flows so far in 2023. And in July, TLT recorded more than $4.7 billion of new money, its best month since its launch of 2002. Can you believe that? That is a significant amount of money flowing into these ETFs. And following July's record inflow, investors on net pulled money out of the fund in August, but they returned in September amid continued bond market sell-off. And investors may want to lock in a long-term yield by investing in a fund that buys long-term treasury bonds, according to Morningstar, but the supply continues to outweigh the demand, and as a result, prices continue to come down and yields continue to go higher. Investors may think the U.S. Treasury bond is somewhat benign, but that's far from the case. No matter the issuer, long-term bonds are more sensitive to changes in interest rates than intermediate or short-term bonds, and therefore are often more volatile, as we already know. And the current SEC yield on the TLT fund is 4.9%. And that represents what investors can expect to earn from the fund over the next 12 months based on what the fund has yielded over the previous 30 days. And that's up from 3.7% the fund offered a year ago. So we have definitely seen about a 1,200 basis points, or not 1,200, yeah, so 120 basis point increase in the overall SEC yield. And this another is a very, very interesting stat where investors have flocked into the fund since the Federal Reserve started raising interest rates. During 2022, investors poured $15 billion into the TLT ETF, which made it the most popular bond ETF that year. And despite the fund's 30% drop, the assets grew 77% last year from inflows alone. And since then, inflows have been persistent with the exception of August, which snapped the 13-month streak. And in September, last month, investors poured another $1.5 billion into this fund. So another inflow of $1.5 billion. Now, this right here is also very interesting. So TLT's 17-year duration means that for every 1% change in yields, the fund's price changes by 17%, meaning for every 1% change in the yields, the 20-year yields, we do see a 17% move higher or lower in the TLT ETF. So for example, right now if you come over to US 20Y, right now it's sitting at just over 5.2%, which again is a very, very dramatic number. But high for the day, 5.2%, and 5.2.5% is where we have already gotten up to in the week of October. So first week of October, we got up to 5.2.5%. And this week, the yields are up a little bit over 4.6%. So let's just say that, for example, we rally to 6%, right, on the 20-year yield, right? Another 6%, or let's just say 6.2%. TLT in that case can drop another 17% from these levels, and that's going to put us down closer to $70 on TLT. And of course, since TMF is levered, it is leveraged against the bond market, against the TLT yields. TLT, and of course, since TLT is down, TMF is going to be down since they both move in the same direction. But again, the magnitude is going to be different since TMF, there's so many ETFs. TMF does go down 3 times more than TLT. Then we're looking at, closer to 50% drop here. Wouldn't be surprised if it ends up trading at sub $2. But that all depends on whether the 10-year yield, the 20 or the 30 or the treasuries, right? The long-dated treasuries, if they continue to push higher or not. If the 20-year continues to move up 5.3, 5.4, 5.5%, 6%, then yes, that is going to be a very, very significant problem for most investors. Now, there was another really interesting report that came out. So the bond math shows traders bold enough to bet on Treasury could reap dazzling returns with little risk. And this actually caught my attention, and it was kind of caught me thinking, what are they talking about exactly? And this report mentioned that as investors snap up long-dated Treasuries following a historical route that has seen the price of some of these get cut in half, some traders are using the esoteric bond math to justify making contrarian bets. And their reasoning is as follows. At current yields, traders looking to profit from price swings in the underlying bonds rather than holding a 10-year or 30-year Treasury all the way to maturity theoretically have more to gain from a rally than they have to lose should prices deteriorate further. So what they're really saying is that instead of buying bonds straight up and holding them to maturity for 10, 30 years, why not buy the bond and benefit from the profit that the price gains after the rally happens if the yields start coming down. It's exactly what we have been talking about, exactly what this previous report suggested for TLT. That's why we've seen so much inflows. And this right here was the bond math, which is very much related to Treasury duration, convexity, and asymmetry. And what this basically includes is for every 300 basis point rise in the yields, which I'm assuming depending on the duration of that, if you take a look at the 20-year Treasuries, right? The current rate's 5%. The bond duration is a little bit under 13 years on average, right? Just depending on how much it's constructed based on the different bonds it has. On a 300 basis point rise, which is 3% for the 20-year yield, if it goes from 5 to 8%, the sell-off is going to be 24%, which, again, doesn't really make much sense, right? Because we just learned from the previous report, 1%, which is about a 100 basis point rise, is going to lead to a 17% potential decline in the TLT ETF. And that's because they're using the TLT more specifically, which has a 17-year duration, whereas in this example, they're using the 20-year Treasuries, which has a 13-year duration. So if you do the 30-year, which they are using the bond duration at 16.2, that's when it comes down to 29.6%. And even then, it seems to be a little bit off by what we have witnessed with the other report. And the asymmetry comes in between the fall and the rise. So what this report suggests, a 300 basis point decline, 300 basis point increase in the yields is going to lead to a 24% decline in the bond price, whereas a 300 basis point decline in the yields is going to lead to 52% increase in the bond price. So that's the asymmetry. That's offering a 1 to 2 risk reward trade-off for the bond trade. Is what they're mentioning, but there's been some debate with respect to opportunity costs. So Andy Constant, who is a veteran of the hedge fund Bridgewater Associates, basically mentioned that do not listen to this sort of basura. Table shows asymmetrical returns skewed heavily positive. It completely ignores the opportunity cost of holding a 1-year bill at 5.4%, resulting in a negative 8.3% versus 7.8% opportunity cost corrected return profile. Still look as attractive is what he's asking, of course, in a more sarcastic manner, basically suggesting that the opportunity cost we also have to take into account with the 1-year T-bill that one would be holding on to a 5.4% return versus simply investing in a long-dated bond ETF that's going to benefit from the price going higher if the yields actually start dropping. So that's where we are with this that I wanted to go over. And, the bottom line is, look, we know the opportunity. We see the opportunity, but nobody knows the timing of this trade, right? Nobody in the planet knows exactly when the yields are going to top out and start rotating back lower. And that's exactly why I think it's important for us to take it slow and steady and expect the unexpected, which is to say the yields can still go crazy. I think the 20-year can still go up to 6%. It can still go up to 7%, maybe even 8%, right? Having that idea of that potential possibility will help us to better prepare for what could happen. Not saying what will happen, but what could happen in the future. I'm still building a position in TMF, right? But I'm fully aware that this could continue to fall, and I'm giving myself a certain threshold here because beyond that level, I think it just starts to get a little crazy from a perspective of just equity markets, bond market. There's going to be some flight to quality if the yields continue to push higher, because there's no way that the 10-year yield, the 20-year, and the 30-year can sit at 7, 8, 9% without attracting money, without attracting liquidity, without attracting capital. There's just no way. I mean, what world would we be living in if the US 10-year is sitting at over 10% or even 7%, and there's no one to bite. It would just be a crazy world. I mean, 8%. The last time you were at 8% was going back as far as 1991. And of course, this has been the overall trend lower, but this time it's just completely overshot to the upside, now sitting at almost 4.9%. So let me know in the comment section down below, what do you think about the 10-year yields and of course this entire bond trade? But bottom line is, there's money flowing in. Still, September, $1.5 billion flown into TLT here, and that ETF continues to drop. So, hope you guys enjoyed it. Make sure that you drop a like. Don't forget, subscribe to our channel. Link to our Discord, Patreon is going to be down below. 16% annual discount that's available till the end of this month, and we'd love to have you on board as a MoneyVest member. And as always, happy investing. I'll see you all in the next video.